All right, today was a tale of two different markets. On one hand, the Nasdaq Composite kind of followed and traded within the range that we set up at the end of the last week with those long lower shadows, kind of what we talked about in Friday's market outlook video. But then on the other hand, these sectors, these small sector weightings, industrials and financials, materials, acted as if nothing had happened, and they actually stayed pretty bullish. And so when you look at the Dow Jones Industrial Average versus the Nasdaq 100, it almost looks like two different, completely different charts. So I'm going to break down what that means and which one's right and which one do we expect to lean towards and why from a technical standpoint. We're also going to take a look at, okay, well, if we've got a lot of noise right now, kind of pulling, this bifurcated, pulling apart, then let's take advantage of that noise with the stock, with our trade idea of the day, the stock that's established its own range, and we'll be able to take advantage of any ups and downs it might do within that range. So let's go ahead and get started. Today is Monday, March the 8th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the market forecast on the S&P 500 first, as we always do. And you can see our little bit of a down day today. Even though we did get a higher high, we did come back down. Obviously not even coming close to the lows that we saw last week on the S&P. We'll take a look at the NASDAQ here in a minute. But the down day did bring the intermediate line back down. So we went from dark green shading back to light pink shading. We are still above 50. Once it crosses below 50, which actually looks like it has a pretty good chance of doing tomorrow, unless we have a really significant up day. If it drops below 50, then we'll be the dark pink shading, and then we'll have our dark pink shading a red line. Now keep in mind, you have to get below this 23% retracement level for us to be considered like we are in an intermediate pullback, right? We barely dropped below there after a bounce up, and obviously you can see how long that lasted. So I don't think this is enough. Yeah, obviously we don't have the red line and dark pink shading yet. So we'll have to see how far, not like we see on the NASDAQ, right, where we do have the dark pink shading and a red line, where we are easily below the 23% retracement, not even close. And as we mentioned in Friday's video, that we could, trade within the range of that long lower shadow. And that's exactly what we did on the NASDAQ today. We came back down into the reversal zone for the intermediate line. So back to dark pink shading, well below the moving average, well into the retracement zone. The bottom of which would be considered a support level. So down to this 12,050 area. Of course, there's a good chance we can come down eventually once everything else starts to follow suit, right, with this kind of intermediate pullback down towards this 11,550, or right above it actually where that 23% retracement level is there. That's probably about, maybe go down a little bit more, but this is probably the area, the worst case scenario, down to that 38% retracement. You look at the Russell 2000, we're still well up above here. But you notice there's not that big of a gap between the intermediate's 23% line and the market sentiment's 23. That's because most of the long-term move that we've had has been on the current intermediate run. So they're pretty close to being on top of each other. The 38% retracement's way down here, towards, and I think there's a good chance and again, worst case scenario, of course, that we ultimately come down towards the 78% retracement, which would be close to that 50% level on the Russell 2000. Again, worst case scenario. You look at the S&P 500, and you can see again where its 38% is lining up right at the old low points there, but the 23% is lining up at the old highs. So they're kind of bracketing the previous intermediate, the highs of the intermediate pullback, as well as the lows of the last intermediate pullback. So that's probably where, again, worst case scenarios, we get down to that 38% level and we kind of stop there. But again, we haven't even broken the 23% line of the current intermediate run. So take that for what it's worth. You're just not that bearish yet on a broad level. And if you look at the Dow Jones Industrial Average, we're not bearish at all. In fact, we got dark green shading the green line. Like, it is very bifurcated here. The industrials are doing very, very well. And the large cap tech stocks are just not. And a lot of our active trades in our class portfolios, we've kind of naturally gravitated towards that area. So like today was an outstanding day for our class portfolios with all the trades that we had, because a lot of the stocks that we're bearish on were the large caps tech names, and a lot of stocks we're bullish on are these reflationary, reopening economy, industrial type names, and they both had opposite performances today, and we were able to take advantage of both opposites there. So That's the kind of trade, that's the kind of market we're in. That's why we say, okay, we just have not had a broad sell-off yet in risk appetite as a whole. It's been very limited to the Nasdaq, and the question is, will the Nasdaq turn back around and catch back up? And it won't until it gets back above this 23% level, or will the others finally break through theirs once the weakness bleeds over, and start more of a broader risk off type move? That's the question, especially now that we have this bill that was passed in the Senate that everybody's been largely expecting and pretty much pricing in since the election. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That lets us know that you liked our video today and that you want us to do another video again tomorrow. Quick way to give us feedback. You can do it with one click. If you don't like our videos, of course, you don't have to click on anything. But if you do like our videos and you want to let us know, you can do it with one click right now, even while you're watching. Just go down there. Also, while you're down there, comment what stood out to you in today's video. What did you learn? What did you get out of it? What questions or comments do you have? Post those in the comments section. We had some great comments from the weekend video. We appreciate those. Join our website at marketscholars.com. There's a link popping up right there at the top right corner of your screen. Click on that link to subscribe to our site for free. One of the things you get is access to our Market Outlook forum, our message board on our website, so you can be able to interact with other viewers of the video. Also, follow me on Twitter for more content in between the videos from day to day. There's my handle up here at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our website, check out some of these other things over here on the right. Our Market Outlook live video. Every day I do the Market Outlook. I do a live video at 3:30 Eastern Time. We take a look at all the existing trades that we've done in all these Market Outlook videos. We continue to manage them from all the way up to the time that we close them. So that's what we talk about in those videos there, how all those trades are doing. Some of them have been doing very well here, so check that out. And then come over here, and these are our trading rooms that we have coming up here tomorrow, and you can see more of them up here if you click on trading rooms. Again, all of our premium and plus subscribers get access to those live videos as well as all of our trading rooms. Our premium subscribers get access to a lot more, of course, including our message board, our online forums, class forums, as well as our Q&A sessions and all of our premium resources here. So check that out. Come down here, hit this heart. It opens up a new tab. Hit that like button right there. Also come over here, hit this thumbs up icon. Again, opens up another new tab. Hit this like button right here. Again, the more you do that, it benefits us because it goes out to more of our followers. More of our followers will see it because it has more likes and engagements. It benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, now let's get back to the charts and let's take a look at the long term, how this week's chart's starting off. Remember, only one day in. You can see a very, very small candle there for the week. For the Russell 2000, it's very small too. Look at the Dow Jones, still very bullish. So, again, it kind of shows you the differences. Whereas the Nasdaq is a very bearish candle. It's a lower close. It's not lower than last week's low, but it is a lower close. It's a lower, no upper shadow. And then, of course, getting a closing below last week's low would be the next kind of stage of being bearish. But, obviously very bearish candles with falling momentum. Not the case everywhere. Still have very high momentum. So any upside is still going to be very limited in the Dow, even as bullish as it is. And the S&P and the Russell's momentum, long-term momentum, you can see has been rolling over and hasn't broken that 50-day moving average yet, which is lined up with the 23%. Same thing on the S&P. It's, when you look at the intermediate trend if you look at this intermediate trend, you can see the 50-day is also lined up with the 23% retracement. So breaking through that 50-day when you have such a wide gap usually means we make a run towards the 200-day. That's kind of what you're seeing on the NASDAQ, and we'll see how much, when that starts to play out on the other indexes as well. Let's take a look at the 3 green arrow chart. If you take a look, you notice we have 3 red arrows on the S&P 500 with very strong volume. You can see kind of how, here, let me get rid of, let me not fit these studies, there we go. You can see how, again, we're below that 30-day moving average. You got the stochastics is rolled back down. The MACD is still red. If you look at this, you can see you're still below the 17-day moving average. So as bullish as the S&P was on Friday, especially, we're still below a falling 17-day moving average. We didn't get above it on Friday. We're back below the 8-day again today. When you look at the Qs, you can see we're well below. You see how bearish that is. You look at those Russell 2000, and we're still kind of flirting, but still below that 17-day moving average and back below the 8-day. We never did get above those either on Friday. But then you look at like the diamonds, and again, you're above a rising 8-day and 17-day moving averages that are both above the 30s. So, but a long upper shadow here, so something's going to give. Either the Dow is telling us something that the NASDAQ doesn't know, or the NASDAQ is telling us something that we haven't seen yet in these other indexes. And so that's the big question, right? Which one's going to give first? And right now it seems like the Dow is more of the anomaly than the NASDAQ is. The NASDAQ seems to be more of an exacerbation of what's going on in the Russell and the S&P, whereas the Diamonds is doing its own thing, which you kind of would expect to do with a 30 stock average that's price weighted instead of market cap weighted. Let's take a quick look at some of these other indexes. You can see how neutral some of these are. The S&P is back between 100 and negative 100. We're still between 40 and 60 on the S&P, so very neutral patterns there. You look at the trend strength. We talked about how we're between this. When you're between negative 1 and positive 1, you're very neutral, very weak. Even if we're not very, we're still above the green line here and above the blue line. The trend quality noise balance is showing us noisy patterns. That's not surprising. And you look at the DMI, and you can see how the negative index is coming down still. The ADX is still well below 20. So we haven't really got a directional move yet like we have in the Qs, where the ADX is jumping pretty sharply. So again, something's got to give. Either that rise in the ADX is going to show up in these other indexes, and this bullish move in the Dow, which has got a very non-directional move, about as non-directional as you can have, is more fluff than anything. So that's kind of the idea, and I think I would steer towards leaning to what the NASDAQ is trying to tell the rest of the market, rather than thinking that we're going to follow what the Dow Jones Industrial Average is trying to tell the rest of the market. Now let's take a look at the intraday move today, and you can see again we hit up with some resistance. That rally was great, but it hit up with some resistance up here, and now we're falling back down, and you get back below this area 383, and it's hard to stay. It's really easy to get back down here again. It's just as easy as it is to fall and rise. It's just easy as fall. There's very little support in volume, and you saw that in the Qs. We're building up a lot of volume down here now, which again is going to make it very, very hard to get back up above. That's why it's struggling so much relative to what you're seeing in the S&P. And look how much volume there is above the IWM, and how much little volume there is below IWM. So again, in terms of risk reward, anything, you can go up, you can go down, anything can happen in any given day, but there's a lot of resistance on the upside and not a lot of resistance on the downside from the price moving, right? When the price slogs through all that volume, that's a lot of resistance to work through. When there's not a lot of volume down there, there's not a lot of resistance to work through. It's very easy to move through that level, as we've seen, both to the downside and back to the upside. But because it was so hard, so fast in both directions, the environment still exists where you break this level 217, then it's going to be hard for it not to fall just as fast to the downside again, like we saw before. Let's take a look at today's volume and range. As you saw, the range today was about 6.25 points. You'll see that's about average. The volume of 122 million. When you put those numbers in the context, that 6.5 points is right about the average, which is a lot higher than what it was, right? We're flirting up here with that 2% mark, and rising volumes. These are not bullish, right? When these lines go up, that's not bullish. That's typically bearish. Now volatility, you notice started off the day down, but at the very end of the day you can see is rallying and seeing if it's forming a low point here, and if that trend persists, we've been forming higher lows and and roughly higher highs, but we kind of stalled out there just above the 95th mark. I would expect the next high point, if we were to follow suit here, to be up towards 100 to 105% again, and a close around 105% would be indicative of the beginnings of an intermediate pullback. And again, we don't have the same kind of chart for the NASDAQ 100, but the NASDAQ 100 volatility is up in the mid 30s, even if the VIX is still right around the mid 20s. So we are seeing that type of move in the NASDAQ 100, and now the question is whether we'll see it here to confirm that we are indeed starting this drop. All right, so to summarize, obviously we talked about on Friday that we tend to get the biggest up days when we're below these moving averages, and that's kind of what we saw. And today, because the moves at the end of last week were so big and so fast and not really supported by a lot of volume at any individual level, because we were just going up and down, that it's left the door open to fill in the range of late last week. And we already have in the NASDAQ today. The question is whether or not we will in these other indexes too, and they are still susceptible to that type of move, depending upon what might produce it, what catalyst might actually spark that kind of move. So I expect from a technical perspective that we will kind of follow suit. That the NASDAQ 100, which is market cap weighted, which is very influential in the S&P and the broader market as a whole, probably has more to say about risk appetite than, like I said, the Dow Jones Industrial, which is 30 price weighted stocks that are keeping a price weighted average up at uniquely bullish levels right now. It's kind of doing its own thing. Not even like the small cap index, which has been more correlated to the Dow. Even the small cap index isn't nearly as bullish as what we're seeing in the Dow Jones. So whether that will begin this week or whether or not we're still in noisy ranges for all these indexes aside from the NASDAQ. So until we break out of that noisy range one way or the other, then we'll still continue to be noisy, both to the upside and to the downside. Until eventually, like I said, I expect that the rest of these indexes will follow what we're seeing on the NASDAQ, where we'll have more of a broad intermediate exhale, which will not be the end of the world and will not fall off a cliff, and the markets won't tank, and it will just be a normal, exhale of this big, nice, long rally we've had, so that we can now have afterwards another big, long rally to come after. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggest why you're either a lot more bullish than I am or you're a lot more bearish than I am? All right, if we take a look now at what's driving today's price action, you can see the dichotomy here. So, at this point in the day, you can see small caps had hit their high, close to their high. The S&P was near its high right before they started to turn over, and the Qs were negative, right? And the emerging markets were really down. Commodities were down, and gold was down with the dollar being bullish. So, at this point you're looking at and you're thinking, it's a pretty risk-off day, but small caps were so bullish, and the S&P was so bullish, and developed markets were doing okay and really outpacing emerging. But by the end of the day, you can see how everything had dropped back down. Small caps stayed positive. The S&P dropped into a negative territory by about 0.5%. Commodities were down 1.5%. Gold was down 1%. And the dollar is just really continuing to make a strong move. In my opinion, not a trend-changing move, but a pretty strong move nonetheless. If you take a look at the Euro-US dollar here, ending up with an oversold cluster. Now, the last time we got an oversold cluster, that was the turning point, back up to the 23% retracement level. The next time we get a rally, it'll probably get to the 38% retracement level on the dollar, and that's about where the 30-day moving average might be at that point. Again, keep in mind that this new cluster, this was today's cluster, the first one. The second one is for the current period, which actually just started about an hour, a few hours ago. So the way the currencies work, the period starts in the evening, goes all the way through the next day until the next evening, a 24-hour period. And so keep that in mind. we're just barely starting that one. But that's, we broke the 62% retracement level. I told you before that I thought we could get down to the 1760 level. Looks like that's where we're headed with this clear break of that 62% retracement, which is a pretty decent support level. Now, we might pop back up here for a day or two to retest that level, but considering how we've broken that, I think it's going to be very easy for us to come down towards this orange line, which is the 38% retracement of this big bullish move, which lines up, coincidentally, with the 78% retracement level of this rally. This 23% line, that's a much longer term line. You'll see it here on this long-term chart. That's of this, in fact, I have to go out even more than 10 years. That's this decline right here, and you can see we had started up. We did get above the 23% level. We hit the 38 for resistance and the downward trending support line. In this case, we got back up to the 23% line. We broke through it and broke through that downward trending resistance level, and now we're pulling back. And as long as we stay above that 23% line, we're still in this retracement mode to the upside, and I believe we'll eventually hit up. Eventually, I believe all the way up to this 139, 140 area, if not further. So this little, when you look at the pullback on this case, on a weekly chart, light pink shading and yellow line, you expect that we'll probably start to bounce back up at some point in time here. I still think that we haven't had the broad risk-off move that this would be indicative of, so we might not bounce right back up, but considering how oversold short-term sentiment is so far last week and then so far this week, if we finish this week down here at the 38% level, look for it to pop back up, probably up towards the 23% line on any kind of bounce. That's why I think we might not be like selling off it so imminently. There might still be some noise, some up and down noise outside of the NASDAQ before we finally show the selling that we're seeing in the NASDAQ bleed across into other areas. You take a look at at gold right now, and gold is just really struggling. And again, this is a weekly chart, but you can see how it's pulled to the 62% retracement level. You got light pink shade or dark pink shading in a red line, very oversold, multiple clusters on this weekly chart. This is the current week. And we're headed down towards potentially its 38% retracement. This is the current intermediate run, of course. When you look at it on a longer market sentiment type rally, here, let me go daily, sorry. Longer kind of market sentiment rally that started back over here and multiple intermediate run pullback since, then you can see, there we go, and we'll start over here with where it started and all the way up to where it ended. You can see that we're headed down towards that 50% Fibonacci retracement. I think we'll probably end up heading towards this 1590 area. Again, that's while the dollar is bullish, but keep in mind too that eventually, even if the dollar is bullish, during a risk-off type move, gold will get a bid. So, will it pop back up above the 23% line up here? Probably not. But can it get back? Here, let me get rid of this line. It's kind of confusing. Can it get back up to this 38%? Definitely. And that's kind of what I expect we'll see when there is more of a broader risk-off type move. Obviously, we know that yields are making their run. They're still making their run higher. So very persistently strong bullish move that's going a little bit parabolic here. We talked about how high it is above its 30-day moving average, how significant that is when you look at 30 here and then go to simple. There we go. So, we are in the 93rd percentile the past couple of years. So it's a very, very high watermark for the yield up above its moving average. In fact, the only times that we've been higher was this brief pop. So we're kind of going parabolic at the end of this move. We're heading up into some resistance in these 38% retracement, these old lows. So don't be surprised if this is kind of where it stalls, and then TLT, yields drop back down and TLT rises a little bit off of these lows again, in concert with a broader risk off move where bonds go up and gold goes up, and you have your typical pattern that we're still only seeing right now in the NASDAQ composite. All right, now let's take a look at how sectors are performing. You can see, again, how different it is. Like technology, communication services down at the bottom. Energy, incidentally, was down at the bottom too. But at the top, you had materials and industrials and financials. This is a very common pattern. It's not very common to see utilities and real estate doing so well on an up day. In fact, they ended up doing pretty well by the time all was said and done. But again, you can see the pattern that's still here. That, you know, in fact, when you look at the relative strength between the Qs and IWM, look at that. I mean, it's really going parabolic here. The relative strength to the downside. The RSI is broken below 30 for the first time during this whole decline. The CCI, you can see, is down almost back to negative 200. We already did get a pretty significant decline there. And you can see that the MACD is still dropping with a big histogram as well, bigger histogram. So we've really pulled away on a relative strength, away from the 8-day, away from the 30-day. The question is now, is that the parabolic move? Because remember, when this goes back up and turns around, that will most likely coincide with a risk-off move in the markets. Because you can see, obviously, during the risk-on moves, the moves where the markets are up, it's being led still higher by these levels, these smaller sectors. Whereas some of these other sectors, like technology and communication services and discretionary, are clearly in pullback mode themselves. We're just not seeing as well as utilities and real estate had already been in pullback modes, especially utilities. Whereas some of these others showing, look at the long upper shadows showing up and how bullish they are. You can see in long upper shadows in these two showing up at resistance. So it's looking like, you know, this might have been today kind of one last hurrah in these areas here in the middle before things turn more broadly around. We'll see, right? We're still in a very noisy period of until we clearly break out one side or the other. We're still going to have ups and downs. But, you know, I think some of these sectors are showing us where, you know, ultimately where we're going to be headed, and all of these other sectors too. All right, so while we're still in this noisy period, one stock that's been really bullish but then has lost that trend, is now in its own noisy pattern, is Nike. And you can see, you know, the nice little rally it's had off this intermediate run. It's on its own intermediate pullback already. Market sentiment line's falling. The intermediate line's falling too, below market sentiment. Short-term sentiment's not very strong. We're bouncing up. It's kind of oversold technical bounces more so than trend-changing bounces. You take a look at its RSI and CCI. They're both in neutral zones and have been between 40 and 60 on the RSI, between 100 and negative 100 on the CCI. So these are very neutral zones where we've been spending most of this time here. You look at its trend strength, which, you know, Nike did have a very strong bullish trend going. Not as strong as this initial surge, but pretty strong here. But now we're in noisy territory. This noisy move is kind of centering along this strong volume node that's up above the value area, and you've got this pretty decent strong volume node for support, not the point of control, but it's a pretty decently sized volume node right at the top of the value area, right at the 38% retracement zone level of this rally. So you got some pretty decent support, even if the stock itself is showing, you know, relatively bearish pattern here, but you can see it's kind of looks like it's the bearishness has run the course. We might actually start to get back up into this noisy area and stay in the sideways action, again centered around that strong volume node that we're building up in this area that acts as a pull, a gravity pull for the stock to stay around. Again, absent a catalyst that can break you out of that gravity pull, so to speak. So, and you can see the long-term chart. You know, it's been so bullish, and now it just has this falling momentum. And when you have falling momentum, that generally means we just kind of go sideways and don't really go anywhere one way or the other, especially when you got very strong support down below where you're at. So, and you know, if we do bounce back up, you know, we want to give it some opportunity to go in either direction. And so that, of course, leads us to selling a put vertical down where that support is. Selling the 125, buying the 120, selling a call vertical on the upside, selling the 150, buying the 155. This is what the trade ends up looking like. Again, we've done a lot of these here lately, and this is a perfect kind of stock right now for the similar type strategy. You can see I've got the break evens here, set my slices to break even, and then set those slices to the chart, and that's what you see. Those are the blue lines that you see on the chart itself. When you go back to this chart, you can see those two blue lines. There's my upper break even, so room to bounce up and keep going. but there's my lower break even, so room for that support to hold. And if it doesn't, I got a little bit more room for noise. But if it breaks through into that retracement zone, into the lower and into this volume gap area all the way down to the bottom, then we can get out at that point. But it does give us an opportunity for a support level to hold there before we'd have to get out of it. So it would be a significant move, in other words. And at that point, probably we'd be looking for a directionally bearish trade to take advantage of that big volume gap down towards the $100 level. Big round number that would act as support in that particular in that scenario. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Remember, all of our free subscribers get access to that. Open up any new thread there, reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to hit that thumbs up or subscribe to our YouTube channel. Hit that thumbs up icon. Like the video, as well as on Twitter and Facebook too, and then comment on our video. Also, join our, follow us on Twitter, like us on Twitter, join our Facebook group. Again, thank you very much for watching. I appreciate it as always. Have a great rest of your Monday night, everyone, and we'll see you all next time.